This inflation that's been going on, it's not 10 years old, it's not 20 years old, it's not even 50 years old. It is about 90 years old. And I'm counting back from 1933. Why 1933? Because that's when the dollar gold exchange rate was fixed at 35. That's when FDR, Franklin Delano Roosevelt, changed it, or whoever was advising him, probably wasn't him, changed it from 21 to 35. And at that point, that deflation from $21 an ounce to $35 an ounce was enough to get the price system back into whack, I would say, and keep things going. But since then, the money printing has been constant, and they tried to lie about a gold dollar exchange rate of $35 until 1971. And then in 1971, they stopped lying about it. They stopped lying and saying that a gold ounce was exchangeable for $35 because it wasn't. But this inflation has been going on since the $35 change. So that's about 90 years. But in terms of can it go on for another 10 years? I don't think so. I mean, I remember as a kid in the 90s, I didn't hear about everybody being in debt all the time. And there were some struggling people, but, I lived in a, middle class, upper middle class area where people generally had savings and people were upwardly mobile and, things were generally high standard of living. But I remember it changed around 2006, 2007. People were going into debt to buy houses, and then they lost. Debts are still overhanging from there. People everywhere are in debt. I don't know anybody besides rich people, who are not in some kind of major net debt. It's at these turning points when things implode. What I think is going to happen is there's going to be a grind. I don't know how long it's going to take, a few months, maybe a year. There's so much massive stuff going on deep down in the bowels of the monetary system that anything could trip a wire somewhere that nobody saw at any point now. What I think is going to happen, just based on how these things have happened in the past, and these things have happened in the past, is that we're going to see an orderly decline of the dollar in its purchasing power. I don't know against other currencies. I'm not saying against other currencies. I'm saying purchasing power in terms of real stuff you can buy with it. It's going to go down and down and down. Things are going to get more and more expensive.
According to Rafi Farber, almost everybody, except for the staunchest fiat currency believers, knows that the current system is unsustainable. He says the debt just keeps piling up, never decreasing, and it's against the natural order of things. Nature finds balance, but this system doesn't. It just accumulates more and more debt. Farber suggests that everyone knows it's doomed, and that when the dollar's loss of purchasing power becomes obvious, things will likely unravel quickly, maybe within weeks or even days, similar to what happened in Weimar. Farber points out that hyperinflation isn't new. It happened in Israel in 1984, in Weimar Germany in 1923, and in other countries. But those were all cases where isolated currencies had a stronger index currency to fall back on. What's different this time, Farber argues, is that the index currency itself, the dollar, is on the verge of collapsing. He believes that when that happens, other currencies tied to the dollar will either revert to gold or the entire monetary system could implode, potentially leading to a chaotic shift toward private currencies. Farber also draws a parallel with Weimar, noting that inflation there accelerated rapidly around mid-1923. Back then, the only thing slowing it down was the physical distribution of paper money, which took time. Nowadays, he says, with instant payment systems like Bitcoin or Apple Pay, the process could be much faster. He worries that we've never seen hyperinflation in a technological environment like today's, where money can be transferred in an instant. Farber speculates that food prices could double in a month and then double again the next month, eventually spiraling out of control. According to Farber, the only reason the dollar still holds value is that it can be exchanged for gold, though only a few people actually do it. He believes that if everyone tried to exchange their dollars for gold, the price of gold could soar to around $40,000 an ounce, a figure he bases on the Fed's balance sheet divided by the amount of gold in Fort Knox.
So if you go back to the Great Depression and the economic damage that was caused, or no, not that was caused, that was revealed by gold moving from 21 to 35, that's about 60%. Imagine the incredible depression that would result from gold moving to 30,000 in a few weeks. I mean, God, I don't even want to think about it. I don't think we should even think of it this way. Don't even think of it that way. It's not really the gold price increasing. It's the dollar collapsing. It's the dollar losing its purchasing power. If the exchange rate, the monetary exchange rate between gold and the dollar were suddenly moved to 5,000, then what do you think is going to happen? What's going to happen is everyone's going to call in for their gold immediately. Then it's not going to stop at 5,000. Once you get to 5,000, you're going to get to the real monetary exchange rate, assuming there is one, assuming there is gold at Fort Knox. It's not going to stop at 5,000. That's the danger. That's what we're talking about. I mean, at some point, it's not going to be an orderly decline in the purchasing power of the dollar. It's going to go from, let's say, 2,000, and then the next day 3,000. I don't know what the numbers are going to be, but if you look at commodities priced in gold under that scenario, commodities will be pretty cheap in terms of the gold price, because that's the real money. That's what gives the dollar its purchasing power, the gold that is behind it. It's not behind it at a fixed rate, but it is still behind it because you can still exchange for that gold. So once we get to that point, 4,000, 5,000, it's going to be the free market pushing the dollar to its monetary parity at whatever the balance sheet of the Fed is, divided by the amount of gold in Fort Knox. Yeah, so once you get to 5,000, you're going to get to the free market 100% back parity very quickly. The vast majority of people, including the ones that are being sucked into Bitcoin, they do not understand what money is. They don't. When we exchange money or currency for food or for a house or for a car or for whatever, what are we doing? We are exchanging gold for that thing. You don't realize it because it's not consciously there, but that's what you're doing. The big money institutions, the ones who speculate on these contracts, are taking humongous positions in gold and liquidating them and trying to eke out profits and these dollar profits. They're not using gold as money. They're not the ones who set the price. They don't think gold is money. They think it's some kind of shiny store of value, whatever. They use any kind of description of what money can be. Money can be a store of value. It happens to be a store of value. It also happens to be a unit of account or any other descriptions. But that's just what makes a good money. Gold is money. When you are buying something with money, you are using gold. Either you're using a gold substitute or you're using a gold substitute.
Rafi Farber has mentioned that the current price of gold in dollars reflects its industrial use, not its true monetary value. He believes that when people start needing actual money, the price of gold could soar to around $30,000 in paper money. According to Farber, the reason gold is still considered money today ties back to the origins of money itself. He explains that every day, people wake up knowing what they need to do, how much money they need to make, and how much they need to spend to maintain their standard of living. This understanding is based on accumulated knowledge from yesterday, the day before, and so on, going back in time. Farber argues that no government or entity can simply create a currency system and dictate prices by law. It just doesn't work that way. You can't distribute resources without understanding the market dynamics of supply and demand, which require market actions to determine. Farber insists that any monetary system must be indexed to something that already exists, something with historical value. He points out that money began when people needed to trade items they had for items they needed, and the simplest things to trade were gold and silver. It wasn't a centrally planned decision, it just happened naturally because gold worked. Farber suggests that every paper currency we have today ultimately stems from this historical foundation.